what do you think about this? So obviously the charts look similar when we go back to those time periods. However, when we look at the structural difference, I would say 1980s, central banks were selling gold for U.S. Treasuries. We went in that bond bull market. And then 2011, I don't think central banks were buying gold at the levels that they're buying now. And so how would you say, do you think that structurally kind of changes the dynamic somewhat or whatnot? Just curious in your thoughts there.
Sure. And those are fair pushbacks. And again, my base case is still correction and consolidation, not bear market. I am not calling a top. I'm not saying a bear market is coming ahead. I'm just warning people not to ignore that possibility and to pay attention to the data as we go forward. That said, yes, for those reasons, the central bank thing is completely different from the 1980s, materially different from 2011, and that's not all. We also have, we have the administration in the United States, even mentioning the possibility of remonetizing gold or marking the gold at Fort Knox, assuming it's there, marking it to market to help the U.S. balance sheet. Okay, what's a few $1 trillion between friends? Well, with the national debt pushing 40 trillion, 1 trillion extra actually does help. So, there's things like that going on. There's the global de-dollarization trend. And yes, I agree with my friend Brent Johnson that the dollar isn't about to go away. But the multi-decade trend now of the dollar going lower as a percentage of global reserves, that is a real thing, and it's continuing. And recent events have only accelerated that move, or at least the desire to move in that direction. And then there's just sort of the wake-up call that 2025 was to many people that never took gold seriously. It's just a pet rock. It's a paperweight. Doesn't do anything but gather dust. Well, it sure did a lot more than that in 25. And people made money on it. And not just you and I, our fellow gold bucks, but like Wall Street types made money on the gold trade, which was a crowded trade last year.
Yeah.
And so suddenly, you've got all different kinds of constituents here that see gold is more than this barbarous relic, this, ancient artifact of no relevance to modern finance. I think those are actually, I've described them as paradigm shifts. I don't think you go back from that. Once the scales fall from your eyes and you see the reality as it is, wake up and smell the napalm. It's hard to go back to sleep. All of that having been said, there were powerful arguments like this in favor of gold, particularly in 2012. The global financial crisis was sort of like the pandemic, in the rearview mirror, but not that far. The powers that be had done all kinds of crazy things in response to the GFC that were bullish for gold. And none of the people that I looked up to or my mentors thought that the powers that be could paper over the GFC as easily as they apparently did. So, very, very powerful arguments then. And that makes me nervous, as powerful as the arguments are. And I even agree with them, Daryl, the point you brought up and the others that I brought up. I think these things are true. But if gold priced them in advance, the truth of these things won't stop gold from correcting. Or if just Mr. Market decides that gold went too far too fast and it needs to correct more, that won't stop gold from correcting. And one more thing, sorry, curveball here. If the war or the AI bubble popping or anything else, it just being one of the many black swans that comes in and pricks the bubble on Wall Street, we've got two wars, hot wars in the world, and we've got all-time highs in the three major U.S. stock indices. If that goes into reverse, if that blows up, we get a 2008 style correction, everything gets whacked, even gold and silver, just like it did then. If that happens, I think it'd be a spectacular buying opportunity, but I'm not predicting the crash of 2026. I'm saying you put that on the table there, and it's just really dangerous to ignore that possibility.
Yeah.
So where am I going with all this? The takeaway here is that when gold went like this, I took a lot of profits. I have a large amount of cash. I have more cash in my portfolio than I've ever had before, more than I want to have. Normally, I want my money working for me. But in this context, with these unknowns and these risks, I'm staying more in cash now than I ever have before, and I'm looking for the next opportunity to buy low rather than taking a chance on my favorite metals, going higher from here.
I do want to get your perspective on the impacts of the Strait of Hormuz still being closed. So before we went into this situation, there was already kind of more signals of protectionist policies by many different nations, restricting exports and things of that nature. And, I'm thinking about, these critical minerals that are needed, obviously fertilizers, we need copper, we need silver, we need, all of it, right? And with the Strait impacts, China restricted sulfuric acid being exported and such. And I'm kind of wondering your thoughts on does this hurt supply even more? Just curious in what you're thinking about with that type of policy.
Yes, I mean, we could have an hour-long conversation on just this. Some key points are the short-term supply disruptions could easily be reversed. It will take time for oil to start flowing again, but sulfur is not rare. Chinese political decisions can be reversed, so it's not wrong, but it is dangerous to place major bets based on the short-term price movements. Longer term, what you're bringing up, I think, is another one of these paradigm shifts. It's a mega trend that doesn't go away anytime soon. And really, the COVID lockdowns were a major wake-up call. And then Russia's second invasion of Ukraine in 22 was another major wake-up call. Like, energy dependence is not a good thing in a world where that sort of thing can happen. The COVID thing reminded us of not the anti-fragility, but the fragility of global supply chains that can be disrupted. And now this war is like, if the Russia's invasion of Ukraine was a wake-up call, this war is like the people from the front desk at the hotel barging in your room and dumping ice water on your head. This ain't no polite wake-up call. This is just like, wake up, emergency kind of situation. And I think everybody's got the memo. That is a long-term shift. The good news for us as resource investors is that in the deglobalization of supply chains, the national security arguments for supporting domestic supply of critical minerals and other inputs, I think that's an investable trend. That will last long enough, and it will support projects that might not have been viable before when they had to face the lowest cost competition from China or wherever. So I think that's a real thing. I think that's a durable thing. I think it's nonlinear, however. There will be ups and downs. And the thing about big macro calls like that is, like, even if they're true, it doesn't help us necessarily decide what to buy today. And it doesn't tell us much about the timing of when the markets will shift and how things will go. And the other thing about this is, and this is a big can of worms, if part of the critical mineral story is that we need to have these things for war and to have our own supply, and the government's going to make sure, there's a lot of talk about subsidies and price floors right now. That is a material plus for the producers that can't compete on price with China. I get it. That's real. But at some point, political winds can change, or the Americans might decide that our Canadian and Australian friends are close enough that we don't need to pay 3 times as much or spend tax money we don't have to support U.S. producers when the Canadians or Australians can produce it cheaper, like that sort of thing. It's very tricky. So I would just remind investors of those most feared words in the English language. I'm from the government and I'm here to help. Right? Beware of that as an investor.